Hello, what's up, Internet? This is Tahmid of Tahmid Talks back with another brand new video. Today I'll be talking about the top 3 investments that young people can make. Now, a lot of you might be young at heart, but when I say young here, I'm referring to teenagers, young adults, and who are just starting off in their saving, investing, and earning journey. And if you watch financial YouTubers, you'll already know about the effects of time and compounding, and the most valuable thing you have as someone who wants to multiply your wealth is really time. And if you do start off young, you are really blessed, and the younger you start, then the more blessed you are because you have more opportunities and more time, hypothetically, to compound your gains. So straight off the bat, I'll get into the investment vehicles and etc. that probably didn't make the list because they aren't so great for young people. I excluded bonds, I excluded real estate. Yes, physical real estate is not on here. Some of the reasons for that is bonds are much safer and take on much less risk, and it's meant more for older people and retirees, etc. etc. I did not include physical real estate because I think that the prices in most places that we live are unachievable for very young people, and you need a fair bit of savings and earnings in order to be acquiring real estate. Don't be fooled, because I did actually tell you how to get exposure to real estate without physically owning the thing. Houses, condominiums, whatever, and I will get into that in the third part of the list. So that's it. Let's jump right into the top 3 investments you should be making when you're young. The number one thing that a lot of people don't tell you is actually investing in yourself. What is this? What does that mean? Imagine I told you to write down a comprehensive list of the most valuable things you own. And when I say valuable, I mean in dollar terms. Would you put down your electronics, your clothes, your car, your condo maybe, your bank accounts? Guess what? Did you put down yourself? Probably not. But guess what? The most valuable asset in money terms is actually your own skill set and knowledge. Your skill set and knowledge is what allows you to go to this place called the job market and earn money through wages or salaries, or even to start your own business and sell products and services to the world to make something we call profits. Now let's try to put some numbers behind this. I'm from this big cold country called Canada on the North American continent. In Canada, we have a fair number of people who are very highly educated, and many people have an university degree or equivalent. For the average person here with a bachelor's degree from university, they earn about $1.8 million over their working lifetime. Now that might sound like a lot of money, but remember, this is over an entire lifetime of working. And around 360,000 of that, so a large chunk, will go straight up front to government taxes. Not to mention all those costs that you can never easily avoid, like, shelter and food maybe. So the point I'm getting here is that you will be earning quite a fair bit over your lifetime. And forget about, saving and investment returns at this point. The key is, what will you do with all that money, that whole 1.8 million on average? And I'm assuming here that, like most people, you'll get a typical job working for someone else for a wage or salary. There's nothing wrong with that when you're starting off and hustling when you're young in the 9 to 5, because you need some capital in the first place to start off. You probably heard this adage that you need money to make money, and that's really true. So you have to start somewhere and start hustling and really building up your bankroll. And in building up your bankroll, your best bet is really your skill set and knowledge, because this is what you're trading in the job market to make money in the first place. Usually how it goes is that the more specialized and rare your skill set and knowledge set is, the more money you'll be raking in. It might make sense to aim for niche fields where there are high barriers to entry and very high pay as a result, because obviously supply and demand don't match up. Some of those fields include the STEM fields. If you never heard of STEM, it's like a fancy acronym for science, tech, engineering, and mathematics. As you probably know, jobs of that nature require a lot of technical skills and years of schooling, such as neurosurgery and data scientists, so that's why they make the big bucks. There isn't a massive supply of such skilled people. Therefore, if you're listening to this and you're still young in age and still have some time to play around with and a sharp mind, then it makes sense to invest in yourself heavily, build that skill set and knowledge that can be monetized. And don't just go to school for the marks. Try to really learn things that will be useful to you, your future, and hopefully to your bank account. Now listen, if you don't like school or the classroom setting or whatever, there is no shortage of what you can learn on the internet, through books, through podcasts, and the knowledge of other people who have done it before you. So by the time you really hit the job market and you're deep in it, you'll already be ahead of your peers in the curve. So once again, number one, very important to start investing in yourself before you start picking up funds, stocks, or another instrument I'll be mentioning in number 3 on this list. Alright, I already preempted it, so might as well get right into it. Number 2 on this list is stocks and ETFs. ETFs being short for exchange traded funds. Now, before we talk about stocks and ETFs, we need to get 2 crucial concepts out of the way. The first one is called passive investing. Passive is the lazy way of investing for people who are either, lazy or don't have much time to, dedicate to researching stocks, real estate, or whatever, because hopefully, as I said in number 1, you're really busy investing in yourself, building up your networks, your skill set, and your knowledge that will help you make bank in the future. The other concept I want to talk about is robo-advisor, which have made the process of stock and fund picking so much fun and easy these days. And no, it's not robots in suits sitting behind fancy wooden desks to give investment advice. It's rather websites and applications like Wealthsimple here in Canada, who basically do the research and picking for you using advanced algorithms. And the reason I'm telling you this, because young or old, I highly recommend using robo-advisors, and I think they're much better because the fees is lower than, a bank and human advice from a bank, and it's so convenient because everything is online. It's through your smartphone or your laptop or whatever, and it saves you so much time in doing research and etc. etc. Now, if you do want to dabble and do research, the better place to start off is ETFs, which are exchange traded funds, rather than individual stocks. ETFs are investments that track entire exchanges, for example, the Nasdaq or the Dow Jones, which you may have heard of, especially if you're American. And these funds basically mimic the performance of these stock exchanges, which is a collection of all these stocks listed on them. And generally, they have low management fees because it's so passive. You're not paying some suits and people in suits to actively do the work for you. And they have low what's called MER, which is management expense ratio, and over the long term, research has shown that having low MER is a huge determinant of successful returns, because just like your gains, your expenses on your fund also compound over time and eat away at your returns. And remember, the MER is an annual fee, so they take that as a percentage of your total money that you have invested in the fund every single year. Before ETF, some of you might not be old enough to remember, we had something called mutual funds, which were actively managed, and because they were actively managed, the fund fees were massive and really were a wealth destroyer overall. And ETFs, as the name suggests, have tens or hundreds of stocks in them, so you automatically get the benefits of diversification along with low cost and everything else, all the other goodies that come with it. So yes, I highly recommend robo-advisors, or if you want to be a little bit more active, picking exchange-traded funds so you get that risk minimization as opposed to picking individual stocks which have company risks in addition to market risks. Now, if you do think that, you have the magic touch, you're going to be the next Warren Buffett or whatever it is, and you want to actively pick individual stocks of company, which I can personally tell you is a heck lot of work and hard to do well, and it is something that you might be interested in, I highly recommend watching my Money Talks series, where I explain how to pick good companies and stocks both qualitatively and quantitatively. But just a warning, as I said, it's a lot of work, which robo-advisor and just picking ETFs in fields or exchanges that you're interested in will save you a lot of time and hassle. Alright, that's number 2 on the list. That's ETFs and stocks, which I think all young people should load up on. A percentage of your income, after obviously paying for your expenses and having a good emergency savings funds, should go towards this endeavor of picking up stocks and ETFs over time. And the reason I say this is historically, stocks are the best returning asset class, or one of the best over any historical period we look at. We know that from the data, and also stocks have this characteristics where they tend to win big over time, and the longer you hold them, the better they tend to do. That's what the research shows us. And as a young person, what do you have on your side? It's time and compounding, which good companies and good stocks really do. And listen, it's so easy with technology such as robo-advisor these days to get started in the stock market, and we've seen a lot of young people start dabbling with being at home in the pandemic. And often I get questions from young people, what's a good time to get investing, how do I time the market? Well, the simple answer is you shouldn't be timing the market. The key is to invest early and invest often. I'll repeat that one more time. The key to building wealth in the stock market is to invest early and to invest often, and I'll leave it at that. Alright, we made it to number 3 on the top 3 list, and on my list it's REITs, or REITs, which stands in short for Real Estate Investment Trusts. Now, the name might be giving away what it is, but believe it or not, today you can invest in real estate without being a landlord of a physical property. That means no knocking on doors to collect rents, no plumbing, clogged toilets. This is because, along with stocks and funds, today we have an instrument called REITs. These trade just like stocks on the stock market, but these companies have a special characteristics. They're big landlords who own a lot of properties in one basket, and you, as the owner of the company who owns all this physical real estate assets, get a piece of the pie. There are some technical qualities of the REITs, and one of them is that they pay out most of their money, made through the rents that tenants pay monthly or whatever, and they pay it out to shareholders like you in the form of dividends. And this is why they have a high dividend yield, often 5 or 6%, higher than the average stock. Also, like a stock though, the REIT price will fluctuate. It will go down and up, hence affecting your investment value over time. However, REITs generally do not tend to be as volatile as particular company stocks, and then of course, even if it is, it's compensated by offering higher dividends. And if you are just there to collect dividends, which is a share of the profits paid out monthly, quarterly, annually, whatever, to shareholders, then you don't care too much as a long-term holder about these fluctuations. Another important point is, similar to if you were to pick the individual stock of a company, you'd have to do a fair bit of research into these real estate holding companies, just as you would do with any other stock. There are important metrics to look at, such as vacancy rates, rental rates, interest expenses, and etc., to name a few. Moreover, REITs generally specialize in a certain sector of real estate, so you can move in a lot of different directions depending on economic conditions, the regional mix of properties they own. For example, there's your commercial REITs, there's your industrial REITs, there's your residential REITs, just to name a few, and there's your sort of the basket of owning all types of real estate. And as a young person, REITs are a great way for you to get exposure to real estate and diversify your portfolio. You can always hold them and start holding them in addition to your funds, ETFs, and stock. The cool thing is REITs have lots of sort of tax advantages as well on their return, and in Canada they're sort of what we call preferred dividends or eligible dividends, where you get tax savings. And this only matters if you hold them in a taxable account. In the first place, as a young person, you'll probably be building up your non-taxable accounts first. That's what you should be doing, such as your TFSA and then your RRSP. Some big Canadian REITs that everybody likes to talk about, and there's many more, include RioCan and Brookfield. You only have to have a few bucks to get started and build up a share position, and hopefully over time, as they're earning and earning more, you can add more, just as you would with the ETFs and these stocks. Alright, internet friends, that's Tahmid with the top 3 investments you should be making as young people. To recap, number 1 is good old investing in yourself. Really obvious, really important, yet no one really talks about it. Number 2 is picking up those nice ETFs and stocks in the stock market. And number 3, also in the stock market, giving you real estate exposure without, the hassle of clogged toilets and having to have large amounts of cash sitting around for that down payment as houses or whatever gets real expensive, is REITs, or real estate investment trusts. And honestly, as a young person, if you can build up a nice portfolio of these 3 things together, I'm confident you'll do much better than your average peers. You'll do much better in wealth terms than the average person. So that's it. You heard it here. And if you want to learn more, I always recommend going over my playlist, particularly Money Talks, where I talk about all different financial and economic issues. So have a look. Once again, this is Tahmid signing out. I'll catch you on the next one.